Both the standard and itemized deductions reduce the amount of tax that you pay. And in this video, I'm going to show you how both work, who typically itemizes, as well as how you can calculate just how much an itemized deduction may cut your tax bill. So make sure you watch until the end. Welcome to Tax Chit Chat, the place where we talk all things tax, all the time. The standard deduction explained. So all taxpayers have to file an income tax return and pay taxes on the income that they earn, but they don't really pay taxes on all their income. This is because the IRS gives you a certain amount of money to earn that you pay no taxes on, and this happens due to the standard deduction. For 2022 tax returns that are being filed in 2023, the standard deductions allowed are $12,950 for single or married filing separately, $19,400 for head of household, $25,900 for those married filing jointly. And if a person is over age 65, blind, or both, then they will get an additional amount tacked on to their standard deduction. For example, if you're single and earned $45,000, you'll get a standard deduction of $12,950, which means you only pay tax on the remaining $30,050. So as you can see, the standard deduction essentially reduces the amount of tax that you pay. Also, if you make less than the standard, you won't pay any taxes. But you may want to file a tax return, as that's the only way to get the income taxes that were withheld refunded back to you. So if you take the standard deduction, you're basically saying, I don't think I can itemize, I know I can't itemize, or I just don't want to go through the effort. Just give me the standard amount off and I'll pay the tax on the rest. And most people do simply take the standard deduction, like to the tune of 87% of people who file their tax returns. But is that your best option, and how can you tell how much itemizing will cut your tax bill? Itemized deductions explained. Itemized deductions are when you add up all the costs of certain IRS allowed breaks on Schedule A of your tax return. If the sum of the itemized deductions exceeds the standard, then you itemize. And this is because the IRS allows a person to take whatever is greater. So what things can you itemize via Schedule A? Medical expenses. A person can write off their medical expenses to the extent that they exceed 7.5% of your income. This includes things like acupuncture, addiction treatment, chiropractic care, doctor and hospital visits, basically anything listed in IRS Publication 502. Let's say that a person made $50,000. Then your medical expenses must exceed $3,750 to be included in the itemized deduction calculation. And it's only the amount that's above $3,750 that counts towards your total. So who typically is able to deduct medical expenses? Well, the elderly. And that's because they tend to have lower incomes and higher medical expenses. State and local taxes. Next up are the state and local, think city taxes, that you pay. You'll sometimes hear them referred to as SALT for short. If you live in 8 of the no tax states, then you typically would deduct your sales taxes paid, which the IRS allows you to do. I mean, it makes sense. You don't have any income taxes to deduct. If you live in any of the high income tax states, then you'll see why in a moment. In this category, you also get to deduct your real estate taxes if you own a home and personal property taxes if you pay those. That's taxes some places charge you for having things like cars, boats, and other personal property. So why do you get if you live in a high tax state? Well, because the SALT deduction was capped under the 2018 tax law changes to $10,000 for everyone and only $5,000 if you go married filing separately. So if you live in Illinois like us, where we pay a 4.95% income tax, and your family earns $200,000, well, you're already at $9,900 in state taxes. Tack on some real estate taxes, where Illinois has the second highest taxes behind New Jersey, and you'll easily hit the $10,000 cap. Under the old law, SALT was not capped, and it could easily help you exceed your standard deduction. Now, not so much. Interest expenses. A taxpayer also gets to deduct the mortgage interest that they paid in connection with their first or second home. But not only are there limitations on how big of a mortgage you can deduct interest on, there are $1 million and $750,000 limits depending on if the mortgage was obtained before or after December 15, 2017. It has to be for a mortgage that was used to buy, build, or improve your home. So basically, no more home equity lines of credits or HELOCs. Now, the good news, you can deduct interest paid to your bank and report it on Form 1098. Or if you have a loan from, say, a parent or a relative, you can deduct the interest that was paid to them. You can also deduct points you paid that were charged in connection with the loan. Charity expenses. If you give to a charity, you can get a write-off for that too. You can deduct donations that were made in cash. And just know that it doesn't actually have to be cash. The donation can be made in the form of cash, check, or credit card. The only real thing to note is that it has to be an IRS-approved charity. So not some GoFundMe page or you giving cash to your down and out of luck friend. But not only can you write off donations of cash, you can also claim goods, meaning things that were donated to charitable organizations like Salvation Army and Goodwill, such as clothing, household items, and even vehicles. Casualty expenses. This one is pretty limited, but it does apply for some people. If you suffered a loss of property that was 1, not reimbursed via insurance or something else, and 2, was in a federally declared disaster area, then you might be able to get a deduction. So if you were in an area that was impacted by the hurricanes like those down in Florida, or the wildfires like those that were out in California, it might be worth looking at. Our free download. Itemized deductions are just one way to save on taxes. Making contributions to an HSA account, pre-tax contributions to a 401k, or even paying for daycare for the kiddos can save you some coins. If you want to learn 111 ways to cut your tax bill, then consider picking up my book, How to Slash Your Taxes Legally and Ethically. And if you're a business owner, then click on the link in the description of this video or right here to grab you a free copy of our download, 10 Accounting and Tax Tips for Startups and Small Businesses. We'll then shoot that over to you as well as let you know when our new course, How to Set Up a Business from a Legal and Tax Perspective, a step-by-step guide, is ready and available for purchase. So, to make everything crystal clear for you, let's take a look at a hypothetical Schedule A and see just who would take the standard deduction versus who would itemize. So, who itemizes? Let's say that we have a person or family that earns $75,000. They spend $4,000 on medical expenses, but since it doesn't exceed 7.5% of their AGI, they won't get a deduction for it. They paid $3,700 in state taxes and another $1,000 in real estate taxes. They also paid $5,000 in mortgage interest and gave 5% of their income, or $3,750, to charity. So when we add all this up, it totals $13,450. When we compare that to each of the standard deductions for each of the filing statuses, we can see that only a person filing as single would be itemizing. All the others would simply take the standard deduction. So let's change things up. Let's say that now we have a person or a family that earns $250,000. They spend $6,000 on medical expenses, but since it doesn't exceed 7.5% of their AGI, they won't get a deduction for it, just like the first example. They pay $12,375 in state taxes and $8,000 in real estate taxes. But even though this totals up to $20,375, it's going to be capped at $10,000. They paid $10,000 in mortgage interest, and they gave 1%, or $2,500, to charity. So now the itemized deductions total $22,500. But the only group we added when compared to the first scenario were those who were filing as head of household. What we can see under both scenarios is that those that itemize under the current tax law, regardless of the filing status, tend to be homeowners, live in a high tax state, and are possibly charitable. Now, how much is that itemized deduction worth to a person? How much is an itemized deduction worth to you? The easiest way to say this is that your taxes are reduced by the amount of the deduction multiplied by your highest tax bracket. Say that you spend $1,000 on a deductible expense and you are in the 24% marginal tax bracket. You'll cut your tax bill by $240. So if you want to know how much you'll save if you're comparing the standard versus itemized deduction, just see how much you're over the standard. Looking back at the first example, if you had $13,450 worth of itemized deductions and you were single, you would be $500 over the $12,950 standard deduction. If you were in the 22% marginal tax bracket, then you're only saving $110 by itemizing. Now, don't get me wrong, $110 is $110, but you get my point. For this person, the $110 might not be worth the effort of tallying up all their expenses. But if it were $5,000 over the standard deduction, well, a $1,100 write-off might be worth it to go through and look at all those expenses. So the point is this: do the analysis, then take whichever one is greater, whether you prepare your taxes with software or you use a professional. Now, if you like this video and you got some value from it, then consider giving it a thumbs up, or you can say thanks by buying me a coffee. The link is in the description below, and the extra coins go towards helping us make future videos and pay for things like gear and props. So, until we meet again, remember to keep earning, keep learning, and just like that, this chat is adjourned.